This is the L2 Capital Podcast with hedge fund manager Marcelo López. The L2 Capital Podcast focuses on potential opportunities in the market and brings to your industry leaders and an intelligent conversation about their respective areas of expertise. And now, here's your host, Marcelo López.
Hello everyone and welcome to the L2 Capital Podcast. I have the pleasure to talk today to Mike Alkin, who is also a hedge fund manager focusing on uranium investments. Mike and I have been talking for over a year now about our podcasts, and I'm very happy to have him talk to me today. So Mike, welcome to this podcast. It's a pleasure to talk to you here.
Thanks for the invite. Appreciate it. Same here.
Thanks. This year has been very eventful for uranium investors. We had the resolution of Section 232, although we are still waiting for the outcome of the working group. We had the World Nuclear Association Symposium in London. And a few days ago, there was the International Uranium Fuel Seminar in Nashville. Now, for the people who could not attend the seminar, could you please let us know what happened in Nashville in general?
Sure. The WNA is more of a global symposium, if you will, the World Nuclear. That was in September in London, but you saw very few U.S. fuel buyers there. The NEI, the Nuclear Energy Institute, holds their seminar here in the U.S., and it was heavily attended by U.S. fuel buyers. And the U.S. fuel buyers are by a group. The U.S. buys the most uranium in the world. So that it was you get in on a Sunday, leave on Wednesday, and there are a number of panels that discuss the demand side, the supply side, what's going on the policy front, what's going on with advanced fuels, what's going on with different types of new reactors, advanced reactors. So it's people from throughout the fuel cycle, if you will, attended there.
So I believe your presentation, which is always a must-see for everyone interested in the sector, was about price discovery in the uranium market, right?
Correct.
Okay. Could you let us know a little bit about it?
Yeah, sure. Because the NEI is a private organization, it's a trade body, and they charge their members to attend. I guess I think they probably release it at some time. So out of respect for them, I won't go into the whole thing. But essentially, I was asked by them to speak to the attendees at the conference, and many of them are nuclear fuel buyers, which is buying uranium. They buy conversion services and enrichment services and fabrication. So I was asked to give my view. And the reason we talk about price discovery is, as you know, since Fukushima, I think the number is about 750 million pounds of uranium have not been replaced under contract. While these contracts have rolled off, we've not seen a lot of replacement of those contracts. We do see some every year. There is some contracting, but not in mass. And those remaining contracts that were signed at much higher prices are very long in the tooth and mostly gone. So you will be entering a period where for utilities to have comfort with the security of their supply, they will need to embark on quite a bit of contracting. And over the last I guess since January of 18, since we have had the trade action, the Section 232 petition that was filed with the United States Department of Commerce, you really saw fuel buyers pull out of the market because it created great uncertainty as to, for the U.S. especially, and the U.S. leads the way pretty much because of the size of the uranium that they buy, the poundage, that they were not sure if it would be mandated or imposed upon them where they'd have to buy their fuel. So you've seen a lot of delays in terms of purchasing. 2018 was a big year for the spot market, where I think it was 89 million pounds traded, which is 2x what you normally would see, because the spot market is not where they rely upon their uranium. They want to lock it up under a contract. And actually, not to digress, but the question was asked in a live poll at the NEI. The head of marketing for Kazatomprom asked the audience how many people believed that the long-term contracting was necessary and the answer was 80% said long-term contracting is needed. So with Section 232, and I know we say there was a resolution to it, but there was more uncertainty added because President Trump ordered a 90-day working group that took you through the middle of October, and then they couldn't come to their findings in time, so that it got extended to sometime in the next a week, 10 days or something like that. So you've had this pall over the market for, what do we know, to 21, 22 months, where price discovery in size, in real size, let's sit down and talk turkey type stuff, has been delayed. So I was asked to share my views and our insights by the NEI to share that with the fuel buyers.
Interesting. So in respect to you and the NEI, I won't ask for more details on your presentation.
I mean, I'm happy to go into it a little bit. I can give some of the things if you want me to. I could share a little bit of. First, you have to understand who you're talking to, right? So you're talking to fuel buyers. But why don't you go ahead and ask me, and we'll go from there.
No, can you fill us in the details? Whatever you can tell us, that would be good.
Yeah. So they're really asking me to speak to fuel buyers. I mean, there are other people there, but that's the key message that they want me to get across as to our view of what the market looks like. And so we're talking to fuel buyers, and it's interesting now. I've been around the uranium markets about 4 years now. When I first started going to these conferences, whether it was the WNA or the NEI, you're a complete outsider. You don't know anyone. You show up, and as you know, I've seen you there. There's 3 or 4 investors at these, right? There's hundreds of people, 300 people, and 3 or 4 investors.
Sure.
So 4 years ago, it was, oh, you poor fool, why would you come around the uranium market? And they're happy to speak to you. Saying, what, are you kidding? Why would you do this to yourself? And you say, okay, great. And they just view that as, oh, look at this nice dumb guy who decided to learn about this. And then 3 years ago, I over that time, you meet people, you do phone calls with them, and then you see them a couple of times at conferences, and you ask them more questions, and whether it's fuel buyers or physical uranium traders. And then by year 3, or the second year I was doing this, it was a little, I had a lot more knowledge, a lot more depth of understanding of the market, and they were still happy to give you time and talk. And then I started to go public in 2017, in the springish, late spring, I think it was, I forget, late spring, early summer, something like that of 2017 about my views, because during that time period, and you know this from being a contrarian investor, Marcelo, especially in markets that really have had very long cycles one way or the other, either overly optimistic bull markets or overly pessimistic bear markets. In those type of markets, you tend to see the sector become dramatically underfollowed by the institutions. And where you really can be fortunate is when they're very opaque industries. So in the first year, 18 months, I was modeling out every reactor in the world, every mine in the world, every prospective mine in the world, and trying to understand the numbers from my own perspective. You try not to pay too much attention to what the sell side, the investment world is saying, and the research they write, and you do your own work. And so by year 3, going into the third year, I started talking publicly about that. And I did notice a change when I started calling people or showing up at conferences. Now I wasn't just a little guy, why'd you do this to yourself? There was more of a view of, okay, well, this is an outsider. Don't come in and tell us about our market. What do you know about nuclear fuel? And the beautiful part of investing like this is you don't need to be a nuclear engineer like many of these folks are, very smart people. You need to be able to have a fresh and unbiased look at the numbers. So many of them very nice folks, and you still talk to them. And so I'm talking to people who buy fuel for a living, and they are extremely bright people. Like I said, most of them are highly educated, but they're not buying fuel all day long. This is not like the Walmart buyer who's buying shampoo every day, filling shelves, right? This is very rarely do they go out and they go secure some uranium, and then they're off doing what else nuclear engineers do, and what people are trying to get efficiency and improvements in the burn rates and all that other stuff. And because the price of uranium is so small compared to other feedstocks, whether it be natural gas or coal, where it's 80 or 90%, uranium is single digits. The whole front end of the fuel cycle is 20%. That includes conversion, enrichment, fabrication, all that stuff. So there is not this immense focus on understanding the macro drivers of the uranium market. And what you have learned and I have learned over the 4 years is there's a dependency on outside sources for their information. They do their own analytical modeling for internal stuff for their own reactors. But in terms of the macro uranium market, that's what they pay outside sources. Not all, but most. Most of them do that. Not all. There are some who do their own, but it's far in the minority. So that's who I was speaking to, and fully aware. By this time now, 4 years on, while we do speak to them and they're cordial, they also think I'm I'm Gordon Gekko from the movie Wall Street. They think I'm some big bad Wall Street guy coming up telling them they don't know what they're talking about, which nothing can be further from the truth. Our view, if our view is correct, which we think it is, actually saves them money in the long term. But there, and there are some of those, right? Just because I might articulate the message well and I think our numbers make sense, and doesn't mean that they're going to view it as, hey, this guy's just talking his book, right? He has a long bias towards uranium. So going in, you have to know who your audience is, and that's so that was the background and understanding who they are and what they want to do. So what I really started out by doing was breaking it down to say, what do financial analysts do, right? So don't think of me as a hedge fund guy, because there's this negative connotation. But at UR, I am, Art and Adam at Segra we're financial analysts. That's what we do. We analyze businesses and industries, and we've all been doing it for a very long time. So once you've done your own research on the company or industry, I just let them know that, our job then is to compare what we've uncovered on our own and compare it to the consensus estimates and the current prices to what our view of the future is versus their view, because commodities or stocks move up or down based upon whether they have exceeded, met, or disappointed the expectations for that. So tried to lay that framework out for them. And I talked about how investment opportunities with large gaps between consensus expectations and the reality for investors who invest the style that we do in a contrarian nature, those tend to be successful over time. And then contrarian investors tend to be most successful in those industries that are extremely underfollowed, where they've been left for dead, the industry is opaque, and where this groupthink is driven by just a few data sources or a worldview, and that's uranium. And that's kind of where I went with that. And I wanted them to understand where we're coming from on this. And then I walked them through what consensus is thinking. What does consensus say? Now, consensus, there's only a handful of sell-side investment firms covering this, and there's a couple of industry firms that perform analysis on the industry. And you tend to see the sell side, not all, there's a few on the sell side that do their own analysis, but you tend to see a lot of similar numbers to what the more industry-focused analysts will come up with. And really the consensus, what does it say about the uranium market? Demand is dropping through the 2020s from where it was just a couple of years ago. It says supply is not price sensitive, and there's no risk of a near-term price spike. And so then I kind of walk them through is what is the consensus's track record in that? Because you have to remember, as investors, Marcelo, you and me and Art and Adam at Segra, what we're doing is we're looking at changes in numbers all the time, right? Rate of change and who's saying what, and we're putting it on spreadsheets, and we're saying, and we're not only doing our own research, but judging the analysts who are opining on this. And so the fuel buyers aren't doing that. They're not comparing consensus versus not. To them, they've got a couple of sources and they follow it. So what I wanted to do was just kind of take a walk back through memory lane and say, well, let's take a look. This is what consensus says. The numbers that are out there are somewhat dour, but what's consensus track record, right? Did it forecast the peaks and the troughs? Nope. Did it predict supply cuts this cycle? Absolutely not. Did it forecast the 4 or 5 times increase in conversion pricing this just recently in the last year and change? No. Did it forecast the recent 40% rise in separative work unit at the enrichment SWU pricing? No. So that was kind of the backdrop. Here's who we are. Here's what we do. Here's how we do it. And we talked about the way we do it, the way we analyze, what we look at, and all that stuff. And then we shared our view.
And you and I have skin in the game, right?
We have skin in the game. And that is, we can be anywhere. I could be looking at any industry. You can be looking at any industry. The reason we have skin in the game, and not just a little skin in the game, is because we settled upon thinking that this is the most asymmetric investment, certainly for me, that I have ever seen. Asymmetric risk reward, meaning it's not balanced, right? We view the upside versus downside as so dramatic. And thankfully, it's a very opaque market. So what we then talked about is really understanding why we're here and how we got here. And I talked about this notion about what the industry thinks are fully loaded costs to run a mine. And the cost curve is wrong. It's broken. It doesn't make sense. The cost curve is based on it's only really it's the cash cost and the capital costs. And if you were to look at one of the bodies that opine on this, they say it's the capital cost to break even in the current market. It excludes sunk costs. It excludes corporate costs such as G&A, finance, exploration, and other potentially significant costs. And it does not calculate any incentive price that's needed to keep a mine running. And the whole thing is you can't run a mine if you can't afford to run a company. So when people look at these numbers, let's pick McArthur River. Let's pick on McArthur River. Well, it's $16 cost. It's Cigar Lake's $23. The Kazakhs are $15. They're all in sustaining costs. Those are part of the costs. Those are mine level costs. Now you've got to add all the other costs that are associated with that. And Consensus wasn't there. And so when you're thinking about what happened, well, Consensus missed all of the supply cuts. The 25-ish% of global supply, it missed.
Sure.
Because it doesn't cost Cameco $16 to run McArthur River at 23. It might cost them that much to run that mine. But even there's the entire cost to run the company, which you're getting into the low to mid 30s per pound. Right. So for fuel buyers to be sitting there or others to be sitting there saying, well, it's $16, they could sell uranium at 18. It's just not even remotely close. That's not how you build a long-term business and a long-term portfolio. So I walk them through that. I walk them through the same thing with Kazatomprom, where we think the fully baked cost is what we call it, is mid-20s. And so I talked about that. And then what I really wanted to help them understand is how that happened. And I took them through the first quarter of 2017 when Consensus was calling for 150 million pounds of supply. Well, with each mine cut, whether it was the Kazakhs or McArthur River or you saw Ranger stockpiles, Rossing slowing, you name it, whatever has been slowed, all of a sudden you fast forward to today and you're at 31 million pounds. So just in a couple of years, you've seen almost 20 million pounds a year come out of the supply side numbers, right? And that was because it wasn't forecasted, right? So because it largely ignores the financing costs and all of the other costs to run the business. And one of the things that we always hear, and you hear this, is, yeah, but there's all these new projects out there that are going to come online. They're going to fill any supply gap.
Sure.
And you say, oh, right. Okay. Well, Consensus largely ignores the financing cost, the timing, the permitting, and there's billions of dollars of projects that are needed to come online. And I kind of walked them through that by the middle 2020s to avoid a really crippling shortfall. And then why the prices have to double and the window for required contracts is slowing down and stuff like that. So I walked them through the supply side. And then I made a couple of points. I said the development stage companies need about $4.5 billion to build the mines that are needed to fill this gap that's coming up. And uranium mines, you're talking dog years, right? 7 years, 10 years, that's tomorrow. So they need a tremendous amount of runway to be able to get this done. And it was, $4.5 billion. And the market cap of all of the developers is $1 billion. Yet they need $4.5 billion in capital. And, my message to them was good luck with that. What I didn't say, and I should have, I thought about it afterwards, was, Langer Heinrich with Paladin. They have a 5 million pound per year mine. They have relationships. They're a proven producer. They were there last cycle. And when the cycle kicks up again, I suspect that they'll be front and center. They tried to raise they did raise $30 million in 30 Aussie in capital a month ago. And the stock's been down 40%. So, and this is an established company. So if you think the markets, I was reminding the buyers, if you think the markets are going to step up to build these mines that you want now, forget it. It's just not going to happen with these prices. And so, that's kind of where we went on the supply side. And, you tell me, I could keep kind of walking you through it, or you could ask what,
No, that's fantastic. And I think coming from you or people in the sector, it's worth more because, as I mentioned before, and you did too, we have skin in the game. So it's not just a report that we write and move on to the next thing.
Yeah, I mean, and they see that we're here for a while. We've been here, 4 years now. That's not, that's not fast money coming in, right? And one of the things you have to remember, in the last cycle, what you saw really drive these prices higher was about the 06, 07 time period. Remember the prices started moving 03, 04-ish. Really, they started to move a little bit, and then 04 came. You had a little bit of flood at McArthur River. Then 06, you had the Cigar Lake flood, and that's when prices went nuts. interestingly enough, if you were to go back and look, Marcelo, at what the supply-demand outlook was at the end of 2005, if you said, okay, what's the supply-demand outlook look like by 2010? Let's look at the next 5 years. And you were a fuel buyer and looking at those numbers, and you would have said, okay, well, there's a 70 million pound surplus over the next 5 years.
Plenty of supply.
Yeah, right. And then if you came in at the end of October and Cigar Lake, this big monster mine coming online in 07, flooded in October of 06, and you had no idea if it would ever come online, and you did that math, you would have had a 30 million pound surplus over that next 5 years because it came on in stages. Yet there was an anticipated surplus and the price of uranium went parabolic, right? So security of supply is very important to them. And so, when we think about it's a very scary world if miners aren't incentivized to produce, because as we look at it, we see all the state-owned Chinese and Indian production that will be needed. It isn't being sold to the West. You have the state-owned Russian, Uzbek, and Kazakh. That doesn't meet half of world demand. And that's a misnomer by people think, oh, you got all this cheap state-owned entity, they'll sell whatever. Well, first of all, the state-owned production is running at about a 70% utilization rate. Why? Because prices do matter to them. And still, it's not enough. They could bring, I chuckle when I see people say, well, the Kazakhs could bring on a few more million pounds. So what? Who cares? What does that mean? First of all, they got to spend $150, $200 million to do it. But where's that fit in the grand scheme of things? It doesn't.
Sure.
And then some of the other things that I focused on with them was the geopolitical events that really are at the core. If you think about one of the things that was front and center when we were there was the Iran sanctions waivers that they didn't know. Every 90 days, it's decided whether or not those countries and companies doing business with Iran in the civilian nuclear power business will get those waiver from sanctions, because if they didn't, and there were sanctions put on, let's say, Rosatom, the Russian state-owned company, well, the enriched uranium product that the U.S. utilities need to bring in from them would go out the window, right? So they'd have to scramble. And then you have the Russian suspension agreement that's coming on, and it expires at December 2020. That limits to 20% that you can bring in from Russia. So there's a lot of going on. The other thing that you've seen that we reminded them of was you've seen a very, very perfect storm of good things happening for the buy side of the uranium, for the utilities. Since Fukushima, you haven't seen floods, fires, other disruptions. That happens all the time in the uranium mining business. Just hasn't happened. So you had surplus uranium plus no interruptions. They've become comfortable with it.
Sure. And Mike, how did the utilities take it? The ones in the audience?
Well, it's interesting because I did that on the supply side. And I said, look, if nothing changes, you're going to have basically a 58, 60 million pound a year deficit by December 2028. And December 2028 is tomorrow in terms of what needs to be put into production. They understand timelines. And I told them that, look, by 2028, if today, basically I said yesterday, if projects didn't start getting built yesterday and price and long-term contracts being signed yesterday, when you fast forward till 2028, which is tomorrow in uranium world, because of the time lag that's required of all this, you will basically have 16% of global supply coming from the West. And 10% of that, so 2/3 of that, is coming from one mine at Olympic Dam, which is a copper producer, and uranium's a byproduct. And then we talk them through the demand side. And then, so you'll ask how they responded. I'll tell you after. We then walked through demand, and we showed how, for a couple of years, people have thought that, Tim and I are the guys running around with aluminum hats on, tinfoil hats, saying, yeah, no, really, it's a growth business. It's a growth business. We're telling you, it's a 2% grower. Well, the World Nuclear Association came out in September in their biannual report and said for the first time in 8 years, they've increased their projections across their low case, base case, and high case, and that it's one of the best markets they've seen in a very long time. And that's just over the last 2 years. Well, when we did that, we showed our numbers versus their numbers, at the WNA, and versus consensus. And what you saw was since 2017, consensus numbers have dropped off a cliff. They've imploded, while the WNA numbers have gone up a little bit, and we showed them our numbers. But since the fourth quarter of 16, before the supply cuts, the consensus demand forecast for the years 2019 through 2030 has declined by 25 million pounds per year. It's a staggering amount. So all of this positive good news gets captured in the WNA report just released last month. And we've been running around very publicly saying it's a 2% grower, a little bit more, a little bit less, but that basically, and yet consensus numbers during this time period of sort of a renaissance has imploded. So we kind of laid out that math, kind of walked them through that, and showed them the change in the fuel report versus consensus numbers, and it's dramatic. And we shared with them that we think that there's a structural deficit now. We addressed the utility questions. The consensus view is the inventories are too high, and we walked through just for the U.S. utilities, for example, from 06 to 19, the average commercial inventory, which is utility inventory and supplier inventory, is 2.57 years, and you're below 2.5 today. The average utility inventory is 2.1. You're below that today. So the inventory argument doesn't hold weight. And so we got done with all of that, wrapped it up. It's a 20-minute talk, and it was, I would say, it was way more anticipated than I thought. They moved my time slot up. I got there on a Sunday, and everyone told me everyone's anticipating this. And I spoke. It was a packed room, and we had a number of utilities come up to us afterwards saying, "Can we talk?" Saying, "Can we have discussions?" We sat down, or we stood in the hallways, or we grabbed a beer, or we said, "Let's set up a call over the next week or two to walk you through our numbers." And then there were some of those in there saying, "Screw you. Who are you, pal?" They didn't walk up to us and say that, but you could sense it, and you hear a little back channel. Who's this guy to come in and tell us we're wrong? And one of the big fuel buyers there was heard over saying, we do our work. Well, yes, there are a few, and the Pareto principle, I think it's called, the 80-20 rule. And what you see is like this, and when we talk to traders and fuel buyers, they all do their work, whatever work they're doing. But, there's probably 20% of them that are doing their own modeling, their own macro uranium modeling. And you're seeing that expressed in off-market conversations where it's not being put out for bid. If you listen to Cameco, you listen to Tim yesterday or last week on the call saying that, they're starting with a 4 handle, right? So people look at term pricing as though it's $32 a pound, but there are deals being struck higher. They just don't get reported by the price reporters because the price reporters take the lowest bid, not what the deal got signed on for long-term contracts. So if you had a few pounds, if you have a supplier with a few pounds and bid lower, yet a utility did an off-market transaction at a much higher price, that doesn't get reflected. And why that matters is that 80-20, where 20% are doing their own modeling, the other 80% who are not are just looking at what the reported pricing is. But this opened up a lot of conversations, and I was very pleased with it. Controversial, of course, because I'm going up there and shooting holes in consensus, and some of the folks might have thought that I was impugning their work, meaning the buyer's work, which was not my intention. And basically what I was saying is, look, you're going to pay 45, 50, 55, or 60. That's just where the math is going to settle out. Or you're going to pay a lot more if you don't step in right now and start signing these in mass.
Yeah, we did hear from Grant Isaac last week about the transitioning coming, and UXC also presented in Nashville, and they mentioned the reemergence of the SWU markets.
Marcelo, that's a very important point you made. So if you look at, and I don't want to get too technical here on the enrichment math, demand numbers, depending on what transactional tails you assume in your forecast in the enrichment phase, has a dramatic impact on the demand numbers, the requirements in a given year. And it's just part of the enrichment math. And one of the things you noticed with consensus numbers is they drop those tail assumptions way low to where you were, all of this underfeeding was occurring. And it was so that the tail assumptions used out through 2030, once you get past, I think, the mid-20s, the low to mid-20s, you drop down to a number that really implied they were the same tails that they were using at peak underfeeding, which the way it works is the more that underfeeding was taking place, producing that excess enriched uranium that was acting like a mine and selling it into the market, the more you underfeed, the more capacity you use. And enrichers are in the business of selling enriched uranium product, not selling excess uranium that they get out because they have excess capacity. They make far more money doing that. And so and that's done really just through numbers by changing your assumption. And so, yeah, UXC did present a paper, and they in their paper they said we see basically SWU capacity tightening, which means transactional tails will have to go up, which bodes well for not to put words in their mouth, but essentially eventually that means that puts upward pressure on uranium prices.
Sure. So in your opinion, what are the key issues the few buyers are thinking about now?
So one of the things that we hear quite a bit is, hey, I would say from many of them, we know 25 spot isn't the right price. We know 32 term isn't the right price. We get it. But as long as we see those prices, for those that are not out forward leading the pack, these are more of the followers. We've got to go to our chief nuclear officer, our risk attorney, our CFO, and we've got to explain why that's going to be. Well, we're happy to do that. We'll provide you all the data to show you how to do that. But they know these aren't the prices, and so it feels like it's just pushing on a string. It's not going to take a lot. And then what happens is, as you start to see more of these off-market deals get signed higher, Cameco in the first quarter did, I think, 25 million pounds, and these negotiations take a long time. And so you still have the uncertainty about the working group, about the Iran sanctions waiver that just came and passed. But for 90 days, it was a big wake-up call. But as more deals get signed off-market, eventually you're going to have to start seeing those prices reported, right? People focus on the spot market. The spot market, Marcelo, is such a bullshit market, I can't even tell you. If you think about this year, 48 million pounds have traded. Financial intermediaries have done over 60%, 65%. I'm just pulling up my numbers right now as to what we've seen in a given year. Yeah, I mean, right now, spot market purchases through 9 months are down. The volumes are down 38%. And when you look at the split of those, it's 60% financial intermediaries. Last year it was 65%. The utilities are a third. The producers are only 7% of that. So all of these pounds that are sitting in the spot market, these are physical traders that are moving this stuff back and forth 3, 4, 5 times. And they'll trade for a dime or 15 or 25 cents. And the volumes are putrid. They're small volumes. We speak to several of the physical traders. These aren't guys with doing their own macro uranium analysis. They're using the same consensus data. And so they're trading for just, 25 cents, 50 cents, back and forth, back and forth, back and forth. Those aren't pounds being purchased. I mean, a small amount of that, if we look at what's been purchased in the spot market this year from utilities, right? It's 42 million pounds and so 12, 13 million pounds. Put that in context. If it's 12, 13 million pounds out of a market of, 190, I mean, it's nothing. It's just nothing. And last year you saw 88 million pounds. Normally it's 40, 45 in that range. Last year was 88. Why? Because they've been so out of the market and they've drawn down a lot of inventories. They didn't know which way it was going to go with 232. They were in there buying more aggressively. And then as 232 approached, you were supposed to hear something in April, and then it got extended, right, with a working group. That first quarter, they just kind of sat on their hands, and this year they're sitting on their hands. So people look at spot and say, well, it's not moving. It's noise. Because what you see now in the market, you can go buy a few pounds in spot market. If the carry traders come in, which means instead of a utility locking into a long-term contract, let's say they sign a 2-year contract with a trader, and the trader will go out and do a 1 or 2 year deal, and then they have to go out and buy the pounds, and they'll do that, and then they'll have to re-up again. They have to go secure that. The traders most of them aren't sitting on inventory like that, so they got to go buy that. But still, the overall pounds bought this year is nothing. So if you're doing those trades, you're picking up pennies in front of a steamroller, because what's going to happen is a game of musical chairs. And what's going to happen is you're being too smart by half. Right. So let me go out and do a few pounds. Let me do a trade. I'll get a couple then I'm going to go out and buy them and cover them in the spot market. And what's going to happen is they're not going to be there. And then you're going to get run over. So those are games that take place. That's not a game. Carry trading is not a game. It's a real portion of the business. But we just think our view at Sachem Cove is the true underlying supply-demand fundamentals aren't being captured in the market.
Brilliant. Last question before I let you go, Mike. Most people I talk to are puzzled as why the few buyers are not taking advantage of this great opportunity to secure long-term supply of an essential material at rock bottom prices.
Yep.
You and I have talked a lot about this over the past few months.
Yep.
But it will be nice to go through it again, especially now after your presentation in Nashville.
Yeah, sure.
So could you please explain to us how fuel buyers think, how they make their decisions, and what they look at?
Sure. So first off, Mike Alkin standing in front of them, showing them the truth as we see it, doesn't mean they're going to go out tomorrow and do anything. I'm just a Wall Street guy. Where do they think, right? But it does open up conversation. So I saw some people on Twitter saying, this stock, the uranium price didn't move. I was like, what are you, out of your mind? You think because I stood up there and said something, it creates a new train of thought. It opens up discussion. But it's just human nature. So you got to understand, Marcelo, these guys and women are extremely bright. They're extremely dedicated. They make a nice living.
Sure.
They do not get paid to take risk of separating themselves from the rest of the pack. They don't get financially rewarded. If you had an enterprising young fuel buyer or old fuel buyer, middle-aged fuel buyer, and said, I think 22, 24.
Well, just look at the UF6 market. It went up by 400% over the last couple of years, and no one got punished.
You never get punished for paying the same price as everyone else paid.
Sure.
You get punished if you were away from the pack. And it all goes back to, it's not a significant cost. The 2018 numbers came out from the U.S. again recently, the overall cost per megawatt, and costs are down. I mean, so do they have pressures? Of course they do. But at the end of the day, uranium is the feedstock that fuels these things, fuels these reactors. But when you look at history is a great tool here. If you go back and look from go back to 2000, when, the price was in 2003, the average spot price was $11.50, and there were 75 million pounds contracted. When the price was $25, there were 240 million pounds contracted. When it was $89, there were 225 million pounds contracted. And so when it was $50, $47, it was 250 million pounds. They were buying 4 or 5x the amount when prices were going through the roof than when they were lower. Right? Because there's a recency bias, and it's in uranium. It's like this in many industries, and it's easy to extrapolate today into the future, especially when it's been a very elongated market in one direction or the other. And so because that fuel buyer is not compensated or he doesn't keep the spread. Hey, you went out and bought it at 22. We look at that next year. It's 50. You know what? You're going to get a bonus because you made that difference up, right? That doesn't work that way, and it's just not the DNA of the industry. And so it sounds good. Well, buy low, sell high, right? Buy all of that stuff. Throw it out the window. Not only is not how they're structured, but it's not how they've done it in the past. And when prices are 50 or 60 or 70, wherever they go, and everyone's buying at that price, nobody gets in trouble. Where they get in trouble is if they don't have the supply, or where they could also get in trouble is if they have to go back to their CFO because they took their inventories down too low and they got to go back for next year and say, listen, we don't have enough to run these things in a year or two. Now they're going to get themselves in trouble. And you do see this. Like I said, they're very bright. It's just there's only a few sources of information out there, and they use them, and it is what it is. And if you don't get penalized for paying a higher price, now when they do start seeing it go, then they start to pay more attention. And it was a big deal on the conference call when Cameco's, and they've said it the last few quarters. People just have to be listening. You have to be in the fuel cycle. We laugh. I've seen you at plenty of these conferences. Like I said, there are 4, 3. Some, if it's a packed conference, there's 5 investors. I don't see the sell side out at these at the NEI conferences talking to the biggest fuel buyers. Maybe they're not signed up. Maybe they are showing up, but I don't see them.
Sure.
Right. So you listen to these conference calls and you listen to these questions, and you're like, well, show up. Go to some of these and talk to the fuel buyers. Don't just speculate. You go see what's happening. And so this market, I think, is. And by the way, that's not all of them. There's a couple of very good ones that I think are on the sell side, but most of them are consensus. But so they're not financially incented, structurally incented to go out and pay different. Now, like I said, a few of them, right, that 80-20 rule, who are big buyers, they understand the market and they do it. And not that the other guys don't understand it, it's just they have to buy some of these guys have to buy so much fuel they're willing to go out and secure it ahead of time.
Sure. Awesome. Listen, Mike, once again, many thanks for coming to this program and talking to me. It's always a pleasure to talk to you.
Marcelo, always fun. I always enjoy it. Thanks for putting up with me, never being able to figure out the 16-hour, 15-hour time difference, and always having to text you 5 times, making sure I got the right time right that we're going to speak. So,
it's a great pleasure. And waking up early is a privilege.
My wife said to me, I have clocks in my office that say London, Sydney, Moscow, New York, Hong Kong. And I'll be talking. My wife will say, what are you doing tomorrow. I said, well, I have a call and I think it's this time. She's like, what's wrong with you? You have like 7 clocks. How can you not keep track of it? I still can't figure it out. So anyway.
It happens, but it was great talking to you as always, Mike.
All right, Marcelo, it was great. I appreciate it.
Thank you. Bye-bye.
Take care. Thanks. Bye-bye.
If you like this podcast, feel free to forward it to your friends and colleagues. We appreciate your time, support, and your feedback. You can follow Marcelo Lopez on Twitter at MALopez1975. The information presented here is not investment advice and should not be taken as such. You should do your own due diligence and consult with your financial advisor before doing anything suggested or mentioned in this podcast. L2 Capital and its partners will not be liable for any losses that occur in doing whatever is discussed in this podcast.